each of you more or less have a different size of fund. So I'm curious how it dictates your strategy as a fund, and what it allows you and what it doesn't.
I will say Charles and I have the exact same fund size.
Yeah.
So, not a
That's true. But maybe Amanda.
Well, as the baby fund here, so we've intentionally kept our fund size small, and we believe quite strongly that size is strategy. By staying small, one, it means that every check we write, and I didn't kind of specify that, but we have both an angel pool check, which is around 500K, up to a 2 million lead check. Every check we write has a potential to be a fund returner. So we're not kind of throwing a dart for the next round and hoping for the best. We're in it, and then we dilute alongside the founder. And we're only able to do that by staying small. So it also means that every check we write really does matter when we partner with the founder. I would say, we're 4 GPs. Our time is the most limited resource, and we've all come from operating, we've all built businesses. We want to work with our founders, and by staying small, we're able to actually actively stay involved in all our investments. It also helps keep us aligned with our LPs, and I'm not just giving a plug for our amazing LPs, but I think also from a perspective of we can't be in it for the management fees. We're very much in this for the multiples, and we think that by staying disciplined, it was very tempting in 21 to raise tons more and raise an opportunity fund, and we stayed disciplined. We obviously question it constantly internally, but I think we think back to how do we stay aligned with our founders, and by making sure that every check we write matters. We can't just walk away. We can't just pick our favorites. We really try and kind of work with our founders, and they don't have to. Not every company has to go public. We were just looking at the public numbers here for it to be a meaningful fund returner for us.
Yeah.
I can add one. I have a saying. I think the job that we all have. I mean, I'll sort of disagree with the notion of the question. We are pretty much all the same type of fund. We're all seed funds. We're all very focused. We're all sub 300. I guess I think Ed, you're 250, the largest. But I think our job is the same job more or less. I think fundamentally the job of a multi-stage firm is effectively to become as large as possible, because if you look at the way that management fees trade in the public markets versus where carry trades in the public market, it's just a fundamentally different business, right? So they need to raise as much money as they can to make as much money as they can, whereas we all are in this for the carry, and that is how we, like you said, align with our investors, and I think it makes for also a much better founder experience, or so I hope.
And for example, you mentioned that you do like $2 million check sizes, and now we see over the last few years now, maybe 2 or 3 or years, we see that, for example, first, second-time founders or third-time founders rounds are like super expensive, large checks that each of you may need to write. And also today, with the era of AI, we also see, again, very expensive deals. So I'm curious, how do you all navigate this environment? And maybe Ed, you can start.
Yeah, look, when we started Boldstart in 2010, we were writing 100K checks out of $1 million fund. That was what founders wanted, because they said that no one with experience would pay attention to us and write small checks, and we can scale with open source and with the cloud. Today, think about this. The whole lifeblood of a venture firm is to build relationships with founders. When your founder exits, even if it's a good exit, not a great exit, they come back to you, they have so many options now. There's just way too much money out there. There weren't a lot of seed funds back in the day. So the question we all have to ask ourselves is, do I back that second and third time founder? Or do I give it to the multi-stage firms who view that as an option check? And so Boldstart, we decided that, yeah, of course we're going to do that, right? When Guy Bajarni, where we were partnering with him from day one at Sneak, and he's, the company's worth multi-billion dollars now, and he comes out with a new company, and he says, hey, I'm going to raise 100. You're like, maybe you should raise 20. Maybe you should raise 25. And so we ended up co-leading that $25 million initial round. We wrote a $12.5 million check out of our fund. So I think that in order to survive and succeed for us, and other people have different strategies, is that, yeah, we'll go head-to-head with the multi-stage firms, we'll either win or we'll split. But the key for us is that if we do not invest at inception, we will pass. So literally, you can't come back and say, oh, we'll get Ed and Boldstart at the A or in the seed plus. Nope, you got to be pure. So that's what we decided to do. And I think that this is a game on the field that we're playing right now. And if you have amazing founders, I think that's my job, is to back amazing founders who are building something really big. And hopefully the outcomes are much bigger when they raise more capital to start.
I think there's two seed markets. I think if you talk about seed as one market, it makes no sense. Like, how do you compare a 500K pre-seed with the round that Ed just described? So what I tell our LPs is there are two markets. There is the market for first-time, unproven, not particularly well-connected founders. We do 75 to 80% of our investing in that pool. And in that pool, a 500K check will buy you 7 to 10% ownership in that company. And then there's this entirely different parallel universe of repeat people who are price setters, not price takers. And for those of you who listened to David Tisch's comments earlier, if you're going to play in that world, it's just a different ball game. It's way more competitive. You're going to pay higher prices. But in theory, you're getting more experienced founders with a higher risk-adjusted probability of success. And I think as a venture firm, it's very hard to play equally in both of those pools. So most people I know have decided one of those pools is more interesting than the other. And for us, it's the first time unproven founder where we can invest early, knowing that it's probably going to be a little bit more work and a lower hit rate, because that just philosophically and culturally, that's just how our firm's built.
I would just add in there, you know, I'm listening to Charles, and we chat a lot, and we have very similar philosophies. And I think also to Ed's point, we're in the business of exceptions, and I think that we've done not quite at that level, but there are founders that you just have to back and break rules for, and I think, you know, we will do that when we see them. But I was sitting listening to Mike Maples earlier and like nodding my head, and I think our job is to find the less obvious if we are a small fund and we're staying price disciplined. And you know, when we look back at our portfolio, which we do obsessively, it's generally the less obvious ones that we got in really early. Not everyone was fighting to get in, that have been our best fund returners. I mean, you know, Uber at the time, it was a livery company. It was not super obvious. It was in later rounds, or you know, there have been others. So, you know, I think it's a reminder that you've got to know what game you're playing and stick with that, because there are a lot of different strategies out there, and I think you can't do all of them when you're a small fund. When you're a large fund, you can. So
I would say, though, I do hate using the word obvious or less obvious. I just use the word early or bleeding fucking early. And sometimes if you're bleeding fucking early, you'll take some pain. You'll get arrows in your backs. You'll get bullets in your back. But you know, if you take that, so that's what we do. If you're on a market map, I'm not in. If you're Gartner territory, not in. So like when we funded Protect AI in the AI security space as a 3-time founder, he was raising $10 million to start, but he was running ML and AI at AWS. And he said, look, my customers don't have an AI security dashboard. They don't have the ability to understand kind of the vulnerabilities in their AI. This was in October of 21. We're iterating with them. We led the round in January 2022. If we actually led the round now, it would have been priced at like 100 or 130 posts. But we, you know, did a $10 million round at a healthy, lower price, relatively speaking, and they just closed at 460 posts and cranking up customers 2 years later. So it's not about being obvious or non-obvious, because you can get in the trap of trying to be non-obvious all the time. No, you need to make sure that it's bleeding fucking early, and that when it's ready to go, everyone thinks it's the greatest thing ever.
Interesting. Irene, I'm curious about your perspective as a CVC in the end from Telefonica. How do you cope? How do you navigate the competition in the seed? Because you're also doing seed and A. So how do you navigate this?
In our opinion, you need to look for your differential value in the market. You need to look for your product market fit. At the end, it's the same game. So in our case, after 13 years investing as a CVC, we managed to find out our product market fit. And it has to be with our ability to generate business, real business, to our portfolio. So to share with you some our key metrics, we have invested more or less directly in startups, because we invest as well in funds, but we invested up to 170 million in our current portfolio, but we've been able to generate 4x business for this portfolio that is more than 600 million to be real business, not talking about proof of concepts, not talking about real contracts. So that's our key metric, and that's what makes us unique in the market. Again, our tickets are super small. We never lead rounds, but we have something that is super powerful. And again, maybe you will ask us, and why? What about the financial return? So as far as we are evergreen, it's super important to have return because if not, we cannot continue investing. So we managed to balance the strategic investment with the financial return in a way that it works for us.
So your differentiation today to seed founders is basically to try and say, like, I can also bring you business in the end. Understood. And maybe one of the pains or the problems or the challenges that I speak with many of the GPs, both in the room but also just over calls, is just the multi-stage and the challenge of how they sometimes challenge the seed investing, mainly for the smaller or just the seed funds. Yesterday I had a call with one of the GPs, and then he told me, look, if I get to a competition or direct head-to-head with a multi-stage, they can just win me or on check size or on price, or just to bring one of like a celebrity GP and take the deal. So I think this is one of the pains that maybe some of you experience more, and maybe Eric be interesting too.
So I am an extraordinarily competitive person, and a lot of people, early on might have said, as a matter of strategy for Vine, you should follow rounds, you should, play nice with others, and we said that sounds like a really boring way to do this job, right? I think intellectual honesty and ball control is something in a round, working very closely with the founders is so important to us, and it's something that I learned. I started my career at Insight, and so I know, what an aggressive multi-stage firm operates like, and so what we've done, and which I think has worked really well, is we've kind of tried to bring as much of the good from these multi-stage firms into the early stage in terms of really deep research, really deep customer work. We've tried to solve for the top of the funnel problem, which is almost like fundamentally impossible to solve for in seed because our universe of companies is every single human being on planet Earth. And so how have we solved for that? So we brought on a partner, Barak Kaufman, who runs a group called Post-Exit Founders, which is the largest group of second-time founders in the world, and he's now full-time with Vine. And so, my job as we meet these founders, hopefully before multi-stage firms and also hopefully before Ed and the rest of them, is to basically slaughter the idea that they need a multi-stage firm in their seed round, because frankly, they don't. And to make sure that we're providing that research, that relationship very early on. And if they still believe that they need a multi-stage firm, so then hopefully we still have ball control and we're able to introduce them to other multi-stage firms, co-lead the round with them, which is something that we've done now about 8 times in our second fund. And so that's how we compete. It never feels good to lose to them, but as I always say, if you have to lose, may it be to Sequoia.
I put my helmet and cleats on every single day. And on the big rounds, that's what you see all day long. I would say a couple of things. One is, you mentioned ball control matters completely. So you have to have the fund size to lead the round, whether it's 10 or 2 or 15, number one. And that means speed wins too. Like we should be able to make decisions much faster, come to conviction much faster without having to deal with 8 partners. 3 is drop the term sheet first. Those are the ways you win. Of course, I find that the smarter founders who have been around the block longer know what they get with a multi-stage firm. You can always get them to pay up 5x or more later in the next round. And so, in my opinion, that is something that every one of us messages all day long. And if they sometimes do take the multi-stage firm on, we'll split it. But we'll say, hey, you know what? Maybe put that other firm on as a board observer, and if they lead the A, they can join the board. And if they don't, we'll kick them off. And I'll take the board seat, right? So there's a lot of tactics that you can employ if you decide to go after these larger funds, larger groups. But we also do the small checks too, so that's a different game. You play with angels and everyone else, right? So that's how I'd win. Speed.
Maybe about liquidity. Liquidity is also a pain. And yesterday we also had another panel about growth investing, which we also discussed about liquidity. But I'm curious, you today, first you want, of course, to show DPI to your LPs. And second, just you want liquidity, of course, also for yourself, for the fund, and all the right reasons. So then I'm curious, first, how do you know when to potentially actively sell a position or help a company to do an M&A? And also the second thing is that in many years, selling a position as an early stage investor was sort of a taboo in the market. It was something that VCs used to say, like, we are here for the long term and we'll back you, we will never leave you, and all these mottos. And maybe things have changed, so how you manage these expectations? Charles, please.
I mean, we have a different, I think everything is a feature or a bug depending on which way you look at it. So we don't take board seats. I think it's harder to pull off secondaries when you're an active board member on a company. I think the signaling issues there. So we don't take board seats. And oftentimes, like Ed and everyone here on the panel, we're investing along the same time as the founders. So I'll just tell you a story of a Series B secondary we did. The founder got a term sheet from a big multi-stage fund to do the B, and the founder called me and said, "You've been in this thing as long as I have. I've been reading about DPI. Do you want to sell?" And I said, "Yeah, we're not going to sell the whole position." So I'd say the biggest change we've made as a firm is, for a long time, we were buy and hold. There's no reason to sell. Yes, it takes a long time, but why would you sell? And kind of in 21, we started looking at it and said, well, let's shift our perspective from being a default holder to a default seller of a specific portion of our portfolio when it meets certain parameters. And it's been great. It's allowed us to return chunks of capital back to our LPs early in life. It's a pre-seed fund. You're going to get most of your money, I hate to say it, in years 12 through 15. That's the truth for these kinds of funds. But you shouldn't have to wait till year 10 to see something. So we found it's easy to talk to founders about it because, candidly, in many cases, they're selling in the B too. So we're not asking them to do something that they're not themselves doing.
Yeah. In our case, it's a different view because we want to be close to this startup that is growing with us. So as long as we have no value to deliver to our portfolio, I mean, there's no possible business or whatever happens, makes no sense to be part of Wayra. But for sure, we take the decision to exit if maybe there's a financial mindset. But we tend to accompany and to follow those startups that generated more impact. So we have not a regular VC mindset in terms of executing exits.
By the way, we are on the boards of the companies, so I'm still on the board of Sneak, for example. And to your point, it is a tricky situation, right? And I love the fact that the industry is talking about it now, because then you're getting calls from founders. So the more that Vintage talks about it to get their money back, and the more everyone else talks about it, it's not a taboo anymore. It's like, oh, I understand you have a business to run. And so I think because of that, you know, when founders are raising at $1 billion plus valuations or whatever, you start having conversations. Say, hey, you know what? The next round, your job is to sell the product, and our job together is to get oversubscribed, because then we can all do each other a favor. Maybe some early investors can get a little bit of liquidity. I don't want to sell a lot. I mean, because at the end of the day, you want to ride your winners all the way to the moon, but you do want to get a little liquidity. And these conversations are super, super helpful, and the dynamic has changed. Because I've been doing this for 29 years, and for the first time ever, founders are talking about it more and more in a non-negative way.
Yeah, interesting. By the way, today when you do seed investing, what is the weight that you put on sort of like the exit path of a company? I was also in the past early stage investor, and I think I wonder if the liquidity pressure today push you to make investments in assets that you're more sure about their exit path. Maybe not.
I think what has changed, less on the exit path, but more on actually the next financing. Because I think as the bar has gotten a bit higher, there is can you get this to the next round? I mean, if we think we know how the company's going to exit at the stage we're all going in, I think we're fooling ourselves. Yeah. So I think I think you can look at the sector and look at the multiples in that sector, and I think that comes into pricing. So I'd say from that perspective, you know, if it's in a certain sector, you kind of know that your exits are in the ballpark of a certain range versus another sector. So I think we look at it in those ways. But the journey's long, and we have to believe that unbelievable founders are going to eventually figure out how to find a way to exit.
Yeah. You know, Sonali was up here yesterday. She said companies are bought, not sold. And so I think if you're initial research on the company, on the market, on the opportunity is not that there's this bleeding need from the market for this type of solution, you probably shouldn't make the investment, I'm sorry to say, for everyone who just thinks it's all about the founder, regardless of how good the founder is. And so if you're doing that work up front and the market evolves in hopefully the way that you expect it to, so then you better believe that that's going to be a company that's going to be of strategic value to another much larger company to them in the future. So I think it's all inherent. And regarding secondary, I mean, from my perspective, again, to echo everyone's point here, and probably this is nice for vintage LPs to hear, is like, yeah, I have founders who, one founder who's raised up to over $1 billion valuation in a year, and he came to me. He was like, "Hey, I imagine you probably want some DPI." I'm like, "DP? What are you talking? How did you know about that?" And so it was just very refreshing to hear, and I think it's certainly something that's being spoken about more, and I think it's super healthy for the ecosystem.
I think though overthinking a market can be a trap. So I call it founder market fit, and something I think a lot about is 999,000 things can go wrong, but if the one thing goes right, how big can this be? Because at the end of the day, every one of us in this room needs to have one company that's going to deliver 5 or 6 times the whole fund. In fact, every at-bat should have the opportunity to deliver that for you. So I use something what I call intuitive TAM, which is, for example, let's say, hey, on the AI security space, there's no market for AI security. In fact, enterprises, if you go to CIOs or CISOs, what do they get paid to do? Reduce risk. So if you went to them and said, hey, can I deliver this new novel solution to you that may increase the risk over time for some yet to be determined product, they're going to say, no, I don't need it. So the point is like, but if something happens, if there's a seminal hack, if Tesla gets hacked or something, how big will that be? There's going to be no numbers there. We can get tied into how big the market is and all that, but literally there's no numbers. So those are the bets that you have to make, and I think those are the ones, whether they're non-obvious or too fucking early, are the ones that are going to drive returns for the fund.
All right. Thank you very, very much for coming to the panel, and we all learned a lot. Thank you.